What's up, everyone, and welcome to the Daily Macro Update for Thursday, December 4th. Apologies about the delay. I was having a little bit of internet connectivity issues, but we are back. It always happens around the time when the stream goes live, when you have internet connections, right? I'm always having some type of technical difficulties every single day, whether it's the internet connection or the microphone or the camera, but, it keeps it authentic, right? But anyways, getting into the macro data here today. The title of the video today is All News is Good News because we continue to get some low volatility bounce no matter what the macro data is saying. And so getting into the macro data here today, we received the job cuts numbers for the month of November, and it says that it remained elevated, meaning that compared to other Novembers, this has been one of the highest amount of job cuts, even though it was technically a slowdown in the job cuts numbers. When taking a look at the monthly numbers here, we can see that for the month of November, it was 71 million people. I'm sorry, 71,000 compared to 153,000 in October. When taking a look at the actual report here, the official comment was, layoff plans fell last month, certainly a positive sign, but that said, job cuts in November have risen above 70,000 only twice, once in 2022 and the other in 2008. Typically in November, a lot of the companies have came together saying that we're not going to have any major job, layoffs only because it's near the holidays. That would be pretty messed up. This has pretty much been a common practice since the great financial crisis, or the Great Depression, rather, right, all the way back in the 1930s there. So, but this was a rather large print given that it was November, and so that is some type of indicator there, which isn't necessarily any type of shocking news. It might be better than expected compared to what the market was thinking, and so that's what we saw there. We also got the initial jobless claims for this past week, which slumped to a 3-year low, which is technically a good sign, right? Huge drop off. And again, this is partly due to the holidays coming up here. Continued jobless claims also continue to decline, even though they remain somewhat elevated. And so we're getting a little bit of stability around the holidays in terms of the labor market, which is, again, pretty typical. You don't necessarily see a lot of, job layoffs. And on the contrary, you actually see an uptick in part-time jobs as well. So the holidays is typically pretty stimulative, but even adjusted for seasonality, it is worse compared to last year. So it looks like the nominal numbers are the only things being taken into consideration. But that aside, though, we're looking at one of the better leading economic indicators for the economy, which is United States factory new orders, specifically the version of that is the most important to observe, which is the non-defense capital goods orders excluding aircraft. Let me see if I can shift over and show you guys the full chart here because my face is in the way. Maybe I can just zoom up here just to show you. But seeing this, we've pretty much rebounded to the 2021 highs. And then when you take a look at the capital goods new orders on a percent change basis on a year-over-year rate of change, which is really what you want to look at, this is at positive 4.0%. Again, it's a little bit hard to see because my face is in the way, but there you go, right? So this is still accelerating into positive territory. And so that is one positive leading indicator for the real economy. We got the updated number for the Atlanta Fed's GDP nowcast for the year of 2025. And even though that came down to 3.8% from 4.0%, it's still remaining at way higher levels that we saw earlier this year when it was nearly negative. So pretty large rebound on the second half of the year in terms of the real GDP number, which is interesting considering that, the price markets are more so suggesting stagflation. So there is a little bit of a divergence between the real market data versus what is being priced in. And, if it is getting better in the economy, in the real numbers, then why even cut rates? And so even with this good data, there's still a very heavy lean towards cutting interest rates next week on the December 10th last Fed meeting of 2025. And again, the market is taking this as, the Fed is the Fed and the government, they're severely trying to avoid any type of major hiccups. And so they're prioritizing essentially, not caring about inflation and more so just not going into recession, even if it means inflated nominal numbers and widening the K-shaped economy, which that is very short-term thinking, but that's not really surprising given our governments are always short-term thinking. There's no type of long-term planning that's going on whatsoever, right? We go from, 2 years after 2 years of election cycles. So it's pretty much this rolling decision, short-term thinking until something breaks. Who knows what will happen though? Not necessarily trying to predict when that will happen because there's no point in trying to do that because you'll end up missing out on a lot of different opportunities, which we'll get into here in a second. And so with rising, stickier inflation, although the rate of change of it is slowing down, as well as real economic numbers seemingly being okay towards the end of the year here, when taking a look at the price charts though, looking specifically at the S&P 500, we're continuing to see this bounce on lower volume. And so pretty much every single trading day this week, the message on these live streams has been, don't get greedy here. Don't try and chase the green candles. Wait for a better opportunity at the low end of the trading range, and then take a look at what other bullish trends are holding up while the S&P 500 is as well at the low end of the trading range. So you want to pay attention to what the correlations are doing as well. And so really the big thing to observe this week so far was the breaking trend of the US dollar, because things that are oppositely correlated have obviously had a decent rebound, such as Bitcoin and small cap stocks. And so if we continue to see this decline in the dollar, which at some point it might bounce, which is why it's very important that, you have the dollar, even though it's losing its bullish trend, it could bounce. You have the dollar at the low end of the trading range. You have bond yields remaining near the top end of the trading range. And then you also have stocks at the top end of the trading range. So again, this is really not a time to chase right here. We've just been given a great opportunity this week in order to get rid of any type of losers in the portfolio. So if you're seeing a bounce and you're like, oh, this has been doing bad for the past few weeks and I'm down on it by a lot, but it's starting to show some life. Maybe this is going to rebound and I can finally go back to making money on it. Well, if it's really broken trend, the probabilities of that happening are low. They're not impossible, but in those types of positions, instead of hoping and praying, which isn't a risk management process, by the way, trim a little bit off, put them into better, more bullish opportunities that are having a little bit of a correction this week, such as healthcare. Look at XLV. Much better bullish trend. It's on a little bit of a dip that's happening. This is a great opportunity. You're also seeing this on lower volume. Chef's kiss. Now, bringing up the trading range model, it's not quite yet at the low end of the trading range. So you could wait for it to come down a little bit here, which at the timing of this video, the low end of the trading range on XLV is between $151 and $152 per share. So if you wanted to remain still patient on this, maybe tomorrow we'll get a nice little squeeze where XLV will hit that low end of the trading range, and we can use some of the profits that we've taken from the bounces that we've been receiving this week and get it into more bullish trending assets. So again, don't get sucked in to the bounce that's happening. Do not chase. Don't be like, it's been a long time for me because I've been married for a few years, but when in my single days, the girls would get the ick if you approached them at the bar and you were trying too hard, right? You want to remain relaxed, right? Let the prices come to you. You're going to get another opportunity. Don't worry. I'm talking about the prices now. So, yeah, there isn't too much of a change compared to what we've seen throughout the rest of the week here. But it's just interesting how things that have been in a pretty crazy bearish trends like Meta have been having the best weeks so far. And that's typically a sign right there, right? It's funny that one of our newest challengers, GBall89 there, asked about Meta. I didn't even see the question, by the way. I just brought up Meta. Great minds think alike there, GBall89. But yeah, something like Meta, this isn't it's right at the top of the trading range. It remains in bearish trend, right? This is something like, it would almost be a short opportunity. So yeah, if you wanted to characterize this week into, a simple phrase, it would be things that have been going down aren't going down, or things that have been going down a lot have had a little bit of a bounce. Again, things don't go down in a straight line. Things don't go up in a straight line. So we got a great opportunity with healthcare this week. So that's pretty much what we were looking at. Keeping an eye on something like Bitcoin, though. Now, this is still bearish trend in our model, so it's not something that we are acting on currently. But, if we continue to see that inflation might return, which we don't think it will, as well as if we see any type of improvement on the liquidity dynamics, then maybe we can see Bitcoin having a decent bounce here, which Bitcoin would be a leading indicator of those things. So with it still being in bearish trend, though, again, this is something where if you are bag holding Bitcoin on this way down, if you're trying to appropriately risk manage this, this would provide a good trimming opportunity. But it technically has been getting less bearish. Bitcoin miners as well still remains in bearish trend, but we're having a decent bounce here. Let these things prove let these things prove you that they are back. Don't try and time the bottoms on these things, because you're just gonna put yourself at risk there. Silver finally coming off the top end of the trading range. Not yet at the low of the trading range, but we were talking about yesterday to not chase that. Well, you had a decent red day. And maybe this will prove to just be a single red day and before it goes back up. Who knows? But as far as myself, I do want to see a little bit more work on this silver correction if we continue to get that heading into tomorrow. So that's one thing that I'm going to keep an eye on as well. Interesting seeing a breakout in uranium, similar looking to the things that we were just covering, like Bitcoin miners, things like that. So we'll see if that's able to reclaim neutral trend here. It's pretty close, actually. So that one has been a pretty decent performer since it bottomed in early April of this year. So I do think fundamentally that uranium, nuclear energy will be something that might be a super long-term play, because ultimately I think that the use of nuclear energy is going to become way more popular. It technically is the cleanest form of energy. And when everyone thinks of nuclear, they think of like Chernobyl or any of those other, huge accidents that happened when the technology was very primitive. Whereas now the safety features that are there, as well as, the technology is way more advanced. So I wouldn't be surprised if uranium continues higher. You have uranium miners. You also have the specific uranium as well as nuclear energy stocks as well. So there's plenty of that, as well as, as we get into this more AI-driven world, the infrastructure that needs to be built for data centers and things like that, the demand is just astronomical, and there's tons of investment going into that, not only from the private sector, but also subsidies from the government. So I think that's going to continuously be a theme for the next decade, right? I don't really see that going away anytime soon. So If I was to put a bet on a super cycle, it would be nuclear energy as well as the infrastructure surrounding AI, which there are some ETFs that my team and I prefer, and you can look those up. NLR is one of them. So you can take a look at the individual stocks that are within these ETFs. But what's interesting is that the volatility index of the S&P 500 closed below 16, which is just ridiculous considering just a week ago we were at nearly 28. So huge volatility suppression going on. Again, this is not a time to chase. This is a time to consolidate, take some profits, and shift that into things that have a very clear bullish trend. And I reiterated this yesterday only because I still continue to see a lot of narrative surrounding the Japanese yen carry trade fears as Japanese bond yields continue higher. And still, even with all of that, we are just not seeing a lot of stress in the credit markets. We're not seeing, somebody pointed this out in our group the other day, the spike in the SOFR, the spread between SOFR and IORB. And typically you have these spikes on the month end. So, you can see this huge spike on October 31st. You saw this other spike here on November 30th. And that's because funding stress is the worst at the end of the month. That's typically when a lot of these huge central banks do some balance sheet magic. And so you get these spikes. But still, you can see the uptrend is there. So it's not like this risk is going away at all. But when you see those month-end spikes, you can pretty much ignore them. Now, if it happens in the middle of the month off of some type of catalyst, then yeah, that might be what it's inching towards as it continues higher, right? You can pretty much tell that this is going higher. So the risks are definitely bubbling up here, but that was pretty much just like a month-end markup on that. But in any case, we're just not seeing any of those risks from the Japanese yen carry trade, credit spreads widening, all those things. We're just not seeing the risk happen right now. Not saying that it won't be one day, but there's no need to panic on that. So could we get a Santa Claus rally? Who knows? I'm just kidding. We're not narrative driven over here. I mostly say that to point fun at the people who are serious with, that's all they talk about. Santa Claus rally, Santa Claus rally. Up November, whatever it's called, Uptober. If not to send any disrespect to anyone who says those things seriously, but if you're just relying on narratives, you're not going to have a great time, right? If you're just French frying when you're supposed to pizza, you're going to have a bad time. So that's pretty much what I am seeing today. I tweeted this chart yesterday, and we highlighted this the other day, but what the market is essentially really enjoying right now is this low volatility yield curve steepening environment. As you can see in the chart in the right-hand corner here, on this 1 week performance, we've been having the 10-year, which is the long end of the curve, rise faster than the low end of the curve, which is what's called a bear steepening. Now, a bear steepening happens when you have, growth and inflation typically going up at the same time. That's a huge soft landing signal. A bear steepening is what the market really wants to see, and it got that this week. Now, is that happening on a longer term trending basis? No, it's mostly in a bull flattening phase, which the market can still do pretty well in that environment. And so the little blip that we saw the other week where we had that rise in volatility and a bull steepening, that was a little bit of a scare, but it wasn't enough where it's going to cause any type of snowball effect at this point in time. So yeah, that's pretty much what I'm seeing here. But there's just a lot more, better opportunities that are out there than just investing in SPY. And we've covered those extensively throughout this week. for those people that are in our macro investing communities, you have the exact tickers that we're looking at there. And for those who are looking to possibly get more, macro knowledge to add to your arsenal, maybe you're someone who's had a lot of success already with your investments and you're trying to add another layer to, gain more certainty, as well as just know more about these macro cycles, which are very important here post-pandemic, as you guys have seen, then I would encourage you to check out our 6-week Macro Mastery Challenge, which is going on right now. We had a Black Friday deal internally for the previous cohort of 6-week challengers, and some of them took advantage of that great deal. And so now we've opened up some seats for the remainder of December. But once December 31st happens, we are cutting it off completely, and maybe we'll do it at some point next year, like during the summer, or maybe just doing it during fall of next year. So that's coming to a close this month. But if you guys want to secure your seats, just go to the link in my bio below. Or for those on YouTube, just head to the description where you'll see a link. You can book a strategy session with me and we can review everything on the call. So that's my calendar. I'm probably going to have to block off Monday the 22nd though, because I have an all-day meeting there. So try not to book it on Tuesday the 22nd, but there's my calendar. But what we can do now is head into any questions that you guys might have. And yeah, with that, I'm going to take a sip of water. Let's go ahead and go to the Instagram comments here. At the end of the live, would you mind mentioning a bit about gold regimes? How do you mean about gold regimes? I'm not sure what you mean by that. Maybe you can provide some more color on what you mean there. Is CPER near the low end of the trading range? I don't believe so. No, copper right now is at the top end of the trading range, so exact opposite. It's not where you want to be making large bets if you're not financial advice, just telling you what our model says, right? So it's when it's near the top end of the trading range like this, not saying it can't go up further, it's just the probabilities are lower. You have a higher probability of having a correction from here than going up when it's near the top end of the trading range like that. So if you have CPER in your portfolio, though, fantastic time to take some profits. Good question. Yeah, again, welcome everyone. I know that I started a little bit later, had some difficulties with the connection. I don't know what's going on. I updated my Mac computer to the new software and it's like making it slower. Why does Mac do that? Haven't they been getting like sued every time they do an update? The last one was bad on the iPhone. Oh my gosh. They fixed it a little bit, but it's still pretty slow. But man, that was super bad. I don't know if you guys experienced that. I forget what version it is, but like the liquid glass or whatever it is. They did that for the Mac, and now my Mac is super slow. I don't know. Maybe I should switch over to something better than Mac. I'm just tired of the slowness. I'm already in, but looking to open a position for my son. Oh, okay, gotcha. Well, can't give you direct financial advice. All I can say is that it's at the top of the trading range, and that's not necessarily where you have the best probabilities of having an entry where you have upside. I hate how once you update, you can't go back to the previous update with Apple products. Yeah, that's so bad. They do that on purpose. It's like if it was truly a better update, then you wouldn't care if someone went back to the previous update. Like, why would you do that? So, interesting. Interesting. Let's go through and scroll some of these different comments here on TikTok. let's see. Don't you think most asset prices like crypto, gold, and stocks will go down if Japan increases interest rates? I mean, they have been. They have been increasing interest rates. So, yeah, they've been doing it for a few months now. Let's see if we can bring that up while I look at the other question here. Let's go to. Thoughts on the coming 2 week positive momentum? What do you mean by that? What do you see the future or something? MicroStrategy volume looks decent. Appreciate your thoughts on the volume behind MicroStrategy. We can get to that in a second, but let me just see something here. Yeah, so as you can see with the Japanese interest rates, they've been raising them pretty much since April or March of 2024. So it looks like the last time they raised rates was in January, and I guess they've paused technically all year at 0.5. Let's take a look at the Japanese 10-year. Yeah, so the 10-year bond yield for Japan has just continued to go higher here. That's crazy. But yeah, still not seeing any real type of carry trade breakdown yet. So we'll see. We'll see what happens. MicroStrategy. Yeah, somebody answered or asked that question. MicroStrategy. Yeah, volume has picked up a little bit, but it's still in a huge bearish trend. It would remain in bearish trend even if it had a pretty big pop from here. So yeah, it could be good if you've been shorting this all the way down. Maybe you are covering, some shorts, things like that. But yeah, MicroStrategy remains squarely in a bearish trend. Can you talk about this three regimes: reflation, deflation, and stagflation? Well, reflation is when you're going from, a either disinflationary type, and you missed one. There's actually four regimes. There's reflation, deflation, stagflation, and disinflation. So disinflation is what we've been experiencing right now, where the rate of inflation is starting to come down, but it is still above zero. Deflation is when the rate of the inflation rate is below zero, which that typically happens during a recession or a big slowdown in the economy. Stocks hate that. Stagflation is what we've been experiencing recently, where you have persistently higher, either accelerating or just persistently higher inflation while growth is remaining stagnant or going lower, which is terrible. That's a bad environment for everybody. And then reflation is typically periods of after the fact of some type of recession, and the Fed has stimulated the economy with QE, and we're on the other side of something bad. That's when you typically have a reflation phase. And that's when you have the crazy moves in stocks, right? Think of like 2021 when you think of reflation. Think of like Q4 2020 into 2021. Like that's the reflation phase. And that's where you want to be like pedal to the metal, risk on mode, buying NFTs with penguins with hats, that sort of thing. But we are definitely not in that reflation phase. Hey, Johnny, do you ever take short positions? Yeah, all the time. But the thing is that one of the big rules that we have is to never short and hold positions, right? So it's all about just using it as a hedging tool, hedging your longs with those. So, yeah. Or you could, sell calls if you want to be on the other side of options. Instead of buying puts, you could sell calls. You can, buy puts, that sort of thing, however you want to express your bearishness. Meta has not reversed its trend, so too early to tell on that. Are we in disinflation right now? I think that's where we're heading, which if we have disinflation while growth is starting to come back, that's a sure sign of, at least in the short term, that's a sign of a soft landing by the Fed, in which case, if that happens, it's going to be game on with stocks. And you're going to see the markets continue to rally. So, what Wall Street is looking for is inflation starting to come down steadily while growth is starting to come back. So, and we could be seeing that right now. But that's pretty much all I have for you guys here today. I appreciate everyone for joining. There's no daily macro update tomorrow or, on Fridays at all, but we will see you on Sunday's Sunday macro wrap up. And I hope everyone has a great rest of your week. Thank you all for joining and have a great, weekend here. See you on Sunday. Bye, everyone.